Let's shift gears then and move right on and focus in on the other set of numbers that have come out, and that is Thermax. Joining in is Ashish Bhandari, Managing Director and CEO at Thermax, to discuss the quarter gone by and lots more. Revenues have come in higher by about 41%. Margins have contracted to 6.6%, and the company has seen order booking 9% higher. Thank you so much for taking time out. Let's just understand the earnings this time around in terms of execution, because that has clearly picked up this time around. Has that translated into your order flows picking up too?
To the two questions that you asked, what is the outlook on orders and on execution? The execution part is much easier to answer. In the last 3 years, this is the best we have seen in terms of overall environment for execution. Our plants are working steadily. There is very little interruption, and both supply of goods and demand from customers in terms of picking equipment up is as smooth as it has been in the last couple of years. So that's a very, very positive sign. It also bodes well for clearing our backlog at the committed pace in coming quarters. On the order inquiry side, we continue to see strong demand domestically, and even internationally in certain markets, demand is picking up. I would say, though, that the growth that we were seeing in previous quarters, that growth rate has gone down a little bit, which means that we have reached a new level of activity, but there are some signs of slowing down in certain parts of the market, whereas other portions of the market are continuing to grow. So overall, we see some slowdown on the orders inquiry side in coming quarters.
Now, then one would say that the sequential moderation in the energy segmental margins was perhaps the only disappointment this time around. So what is the outlook on that parameter?
Moderation on the energy segment is temporary. We have been working our backlog, and as you know, for a couple of quarters, we were working through quite high commodity prices. Those commodity prices have leveled down. About 4 months ago, they started to flatten. And then it takes some time for those commodity price leveling up to start to reflect on our bottom line. So we are quite comfortable with our backlog in the energy segment as well. And in coming quarters, we should be able to show an improvement in the margins out there.
But the margins, one sees the fine print. There's been a sharp improvement in the environment segment as well as the chemical segment. And this is, of course, due to the softening of commodities, but there's a pickup in execution. Have I got that right? And is this sustainable?
It should. You can see the last 1 year has been anybody that comes in and forecasts something, and certainly something very different happens in reality. So I shouldn't say I can predict exactly what will happen in the future, but as we see the immediate environment in at least the next couple of months, what you talk about, the general trending in terms of improvement of margins should be delivered by us in our bottom line.
But can we talk about the sustainability of the margins for the chemicals and environment segment? What you've reported, is this sustainable? Can this momentum continue? Should your investors, the analyst community get used to this?
I think so. Let me take the two questions that you asked, break them up. Yeah, chemicals is not dependent on capex at all. Majority of our chemicals are outside of the capex business. They are more for run rate, continuous use kind of businesses. And even as part of that, the majority of that is exported out of India. So that portion of the business had certain challenges where we were impacted by freight prices, weakening of the rupee, where we had some commodity inputs that were coming in. We have managed all of that. Yeah, and as we look forward with a new plant that we have in Gujarat, which has capacity, we want to continue to invest in increasing production out of our chemicals business and continue in this rate that we have hit in this previous quarter from a profitability point of view as well. The environment segment had one portion of our business, which was the FGD business, which was affecting our margins somewhat negatively. I think most of the difficult part of the FGD business is now behind us. We have a big backlog to deliver, but we think this particular backlog we understand well. And while it won't be very profitable, we don't expect too much of a negative news from that portion of the segment. So I do expect stability in the environmental segment as well.
Before we let you go, talk to us a little bit about what order pipeline is looking like. You've got a pulse on ground. You know what's happening. Tell us a little bit more.
Competitive intensity is always high. There's one portion of the segment which is all around waste to energy, biomass, all kinds of green energy related segments. That continues to do extremely well. From a customer end segment point, there are certain segments which are now seeing a plateauing. For Thermax specifically, the refining and petrochemical portion where we saw a wave in the last 1 year, there will be some flattening out there. Even in cement, while some of the older projects, the greenfield projects, we are waiting on, but the brownfield activity has stabilized. On some of our smallest segments, the edible oil segment is now plateauing. But meanwhile, on the other side, we continue to see good growth in many of the other segments that are all on the smaller side, textiles, beverages, all of them continue to do well. So I would say it's a mixed bag. The inquiry pipeline is not growing the way it was a year ago when we were coming out of COVID, but it's still very healthy. But just I would say there are some signs that the growth is coming back.
We're going to leave it at that. Thank you so much for joining us to talk about the quarter that's gone by, but more importantly, on the road ahead as well, on the sustainability of the margin expansion that we had seen, that stock trading in the green marginally. We're going to take a short commercial break, but stay tuned. A lot more to talk about on the other side, including commodities, and we'll touch base with the top management of Olympic Park.